You're listening to The RealWealth Show with Kathy Fettke, the real estate investor's resource.
What's a triple net lease? And what's a DSCR, a debt service coverage ratio, and why does it matter? And most importantly, is now the time to invest in commercial real estate, or is it better to wait on the sidelines until prices come down? I'm Kathy Fettke, and this is The RealWealth Show. Our guest today, Cedric Farrell, is a commercial real estate broker affiliated with Sperry Commercial Global Affiliates. For 30 years, he's been helping his clients navigate the complexities of commercial real estate and business, specializing in retail. And he's here with us on the Real Wealth Show today to help investors understand this asset class better and to see if it's the right fit for them. Cedric, welcome to the Real Wealth Show.
Thank you for having me.
So you are a commercial real estate broker at a very challenging time. What are you seeing out there in the market? Are you seeing investors still being active? And if so, in what?
Actually, a challenging time is probably kind of kind right now with regards to the volume of transactions that are going on. Right. So what we're not seeing are a lot of transactions, and there's a huge gap, a significant gap that's closing between the bid price and the actual asking price from where the sellers are. And a lot of that is being driven and has been driven for the last 12, 18 months or so by the increase in interest rates. And so when you think about commercial real estate, a lot of it is driven by math. And the math portion comes from what kind of returns do you expect to get, and how can you finance the opportunity? And because of the difference between where sellers feel that their value of their properties are right now and where buyers can actually invest, there's a gap. So the volume is down across the board, across large brokerages, small brokerages, and the like. Here, I'm in Southern California, Orange County. The amount of investment sales transactions just in multifamily, it's about 50% less than what it was last year, which was 2022. And that's across the board, depending on which asset class it is. All of them are pretty much down. But there are opportunities, primarily when people have to sell for one reason or another. But the volume is significantly down right now.
So what I hear you saying is that sellers think their property is more valuable, and they're not getting the offers that they think they should get. So they're just not selling. They're just holding.
They're just not selling, or they're deciding not to list their properties right now, and so they're holding. And a lot of them are waiting for the interest rate increases to kind of stabilize themselves, and they started to do that. A lot of them are starting to come to a realization that the interest rates are where they are, which is in the 6.5%, 7%, 8% range, depending on the asset, the investor. Now that it's starting to stabilize and not increase as much, we're starting to get some true idea as to what values are. What's kind of hurting the sellers, I'll blame it I'll start with the sellers on this. What's kind of not helping the sellers, I wouldn't say hurting them, is that because the transaction volume is so low, there's not a lot of measurements against what the price is versus what I'd like to see. There's just not a lot of comps with regards to cap rates and transaction volume. And so that doesn't help anybody in the process.
So I assume the commercial real estate owners who are in fixed rate debt are in no hurry because they are waiting for the market to just sort of settle and land somewhere. But what about people with the adjustable rates due this year or next year? I imagine they're in a position where they're going to have to do something, whether it's refinance or sell. What are you seeing there?
You said the exact word, and those are the folks who have to do something, and that's exactly where they are. And so there's variable rates that are starting to increase on some loans. I think the last number that I saw was close to $3 billion or so across the board of the commercial real estate arena. In the next 12 to 18 months, those loans are coming due. So either the loans are coming due or their interest rates are going up. And when a lot of these investors started 3, 4, 5 years ago, the interest rates are in the mid to low threes versus now you're looking at 6.5, 7. With that means that you have to do something. And a lot of them are looking at working out something with the banks or the lenders themselves. And so they either buy a what they call a cap rate reduction, so they can extend their loans another year or two. Some of them are having to bring in capital, which is requiring. I just read an article a few days ago with, especially in the multifamily, because a lot of those are syndicated at that level. They're having to do what they call capital calls. And a capital call is basically in order to make sure that this loan meets the standards for the lender, we're going to have to put some more equity into the property. So you're not getting your distribution that we promised you. And oh, by the way, we're going to ask you to contribute a little more equity so that we can keep the property from going back to the bank along the way. And then, of course, the other option that we have is you can sell that property. And some of that's happening, and some of that's being forced to happen along the way. We have an internal group within our brokerage where we're really focusing on those types of owners, because they have to do something, as you said, and we're offering them an opportunity to either work out back in the 2007, 8, 9, we call them loan modifications, but basically work out some sort of loan adjustment with the lenders. And we've partnered with a couple of different companies to help them do that with the intent of helping them keep the properties. And you know, as well as anyone, the lenders don't really want to be property owners along the way. So they're starting to really work with these investors to make sure that they don't end up with the properties.
Yeah, there's so many headline news about, headline news that commercial real estate is going to crash and it's in big trouble. But oftentimes banks, the banks don't want to fail. And the commercial real estate is their funds are tied to it. So banks are very much affected when things don't work out for the operator. So I was curious how much banks are going to come in and try to fix the problem, or if they even can.
Right now, they're using that term again, extend and pretend, and most of the banks are really working to extend or work some sort of arrangement out with these owners. And then some of them, the math just doesn't work, and so the ideal world, there's an investor that's going to come in and take over or purchase the property, but the math just doesn't work on some of these things. And I'll suggest office. As an example, a lot of the office vacancy rates are low, and the loans are coming due, and the lenders can't lend on a property that's 80% occupied, and the owners can't pay the debt service on a property like that. And so there's some things that they need to do to work out, and some of them are working out. And some of them, are obviously going to have to come to market in some way, shape, form, or fashion.
Yeah, I mean, it depends on the bank, right? And if they've sold the loan, it seems like in some cases the banks can't do anything. And I don't know what the difference is. Maybe it's the portfolio loans where the bank actually holds the note and they have more flexibility. I don't know. Do you have an insight on that?
Yeah, I don't necessarily have an insight on that. I do know that there are securitized loans. The CMBS loans are securitized, and so they have some very specific guidelines that they have to operate by. And then the borrower also has some very specific guidelines or covenants that they have to perform under in order to keep the loan and to keep the portfolio balanced. And those are sold as securities. And so the general public can actually buy those, and they have to make sure that they meet the guidelines and the standards on those types of loans. And so there's, their hands are kind of tied as far as that goes.
So the more securitized, whereas the local banks perhaps have a little bit looser standards there.
Correct.
and
a little more flexibility.
Yeah, maybe not looser standards. Yeah, more flexibility because they're smaller and less regulated. Okay. All right. So for our listeners who are investors, and I'm imagining not too many of them own office, because when we're talking about office really facing trouble, we're talking about downtown high rise, right? Not suburban small office.
That's a good question, and it's a combination of both. The central business district, the downtown high rises are definitely affected. The majority of those are owned by institutions versus the individual investors or a group of investors, and so those are kind of in a bucket by themselves. And as you move further out into the suburbs, and there are individual owners of some of those, typically if an it you know a lot of folks like to blame things on COVID as far as the work from home trigger, if you will. But typically, if an office is 3 or 4 stories, those are fine. They aren't as affected as the higher stories where you have to come in and park and get in the elevator and go to the lunchroom and all of those other things that go along with it. And so, if you look at those type of investments, there's still demand for those because they're typically owned by a small company. I actually have a property for sale that's an office. It's a 5 unit or five office spaces. And there's a lot of demand for that because individuals, an insurance agency, an accounting firm, a law firm, and places like that are smaller still like to collaborate, and they don't feel as exposed with the large office centers where you ride the metro in and get off and walk through the lobby and those types of things. So there's different levels. And then the other thing that a lot of folks overlook, and I'll go back to the more suburban, the higher quality or the more amenitized the offices are, the less they're affected. And so what we're seeing in places, and I'll use St. Louis as an example, the offices that are a lot more amenitized are actually going to the folks that don't have those same amenities, or the tenants, that is, when I say folks, and then they're recruiting them to come to their office that has a lot more amenities. So if you're a B minus, B-ish type office space or below, you're kind of in peril there also.
Yeah, makes sense. There's too many options. People are going to pick the good ones.
Yeah.
I
exactly.
had a debate on another podcast on the market with Bigger Pockets where people weren't able to really define what office is versus retail. So I was curious because I see, like you said, 3 to 4 story suburban office where maybe you've got the dentists and the massage therapists and so forth. Is that office or is that retail?
That is office.
I knew it. I was right. Okay. So then how do you define office versus retail?
So I would start with the retail aspect, because there's some that are mixed use that go along with that. And so, you use the dentist or the chiropractor, and there are some of those are in what they designate as retail centers. And the space for those are significantly more expensive because of the access and the common area that goes along with it. So I would define retail as you come in and you have a door, there's a dry cleaners in that same center, there could be a dentist, there could be a chiropractor, and those type of things. So it's kind of the surrounding area, a restaurant, a Subway, or something along those lines. Office is more generalized. The way that I believe it would be BOMA, the folks that kind of allocate assets and whatnot, would define it as typically an office space you're going to get per 1,000 square feet about 3.5 parking spaces. So it's also the amount of parking spaces they allocate for the amount of space for the buildings themselves.
Okay. So if you go to a strip mall that's got a Ross and a Marshalls and a Massage Envy, you would call that, maybe a chiropractor.
Retail.
That's retail?
Yes.
Okay. And then
Yes.
office would be the dentist and the cosmetic surgery. It's like 3 levels, and yeah.
Exactly. And because we get inquiries like that, and we get referrals from folks that kind of have that same thought process. It's like, well, I want to be in the center with, the Rosses or something along those lines. And there's a significant price difference between rent for being in a center like that versus being in an office. An office, you're probably looking at $20 to $25 a square foot. For a nice office, you can get $25 a square foot. for a retail nice center, and again, I'm probably using California more as a proxy, but you're looking in the 30s to mid 30s on
Ugh,
a square foot basis.
that's a
Yeah,
lot. As a business owner,
it's
wow, I'm going back to
right.
when I complained about $2 a square foot in Walnut Creek.
Yeah, well, this is on a national. This is on national. You would divide that. Let's say if it's $24, that's $2 a square foot. Then it's by 12. You divide that by
Oh,
12.
okay.
Yeah, you divide that by 12.
Okay,
So
okay.
that'd be $2 a square foot
All
there
right.
for an office.
Got it. So for your clients who have a 1031 exchange and they maybe don't want to do residential, 1 to 4 unit housing that we do at Real Wealth, they want, I don't know, something else, something that they can just set and forget. What do you recommend today? Let's say someone's got a $1 or $2 million exchange they need to do.
I like that set and forget. That's a good one versus the mailbox money. And so that the set and forget is a good definition, meaning that you're not going to be the one who's going and collecting the rent and fixing the windows if the window doesn't work or the doorknob or something along those lines. So you have some built-in property management. What a lot of 1031 exchange folks like to look at, that $2 million is probably about the entry level on this, are properties that they refer to as triple net. And a triple net primarily means that the tenant is going to pay the taxes, insurance, and maintenance on that. And that's kind of where the triple comes from, the taxes, insurance, and maintenance. And those can be anything from a standalone bank to standalone drugstores to standalone offices, as a matter of fact, or in a standalone industrial building. But 2 million is about where you get to where that starts to make sense. Otherwise, some sort of multifamily property, maybe 5 units or more, that type of property is a different loan than a residential loan. And what a lot of folks kind of overlook on that aspect of it is that I mentioned the property management before. It's always, and this is just one person's opinion here from where I sit, it's always better to have some built-in property management versus being the owner. So you can, for your word, set and forget the property and make sure that it's maintained.
Through the triple net.
Through the triple net or through property management if you do look at multifamily as an option.
Got it. Okay, so what kind of return can people expect on a triple net? I don't know, fast food place
the cap rates, and again, this is kind of market driven for today. Over the last year or so, the last 5 quarters or so, cap rates have gone up on triple net properties, and cap rates are a reflection of risk and obviously of cost also. And so as they've gone up, that means that the returns are lower, or the sales price is lower and the returns are a little lower. The cap rate overall right now for net lease properties is about 6.5%. And the darling of that would be the retail. The downside of that, or the ones that are on a little higher end, are the industrial properties, because there's just not a lot of those that go into triple net. They have some different types of leases that go into that, but it's about 6.5% return is what you expect. And again, if we use cap rates, we're talking about if you put that entire 2 million in, you would expect to get about 6.5% return on that.
Okay. A lot of people say, why would anybody buy commercial real estate or any real estate that's returning 5 or 6% when they could just go buy a treasury bond, for the same. So, you as a commercial broker are competing with the U.S. government at this time, except for the fact that 1031 exchanges don't allow that, right? You can't sell a property and then go buy some treasuries and defer your taxes. At least I don't think so. So, there
Right.
are people who would really just like to do an exchange from maybe one type of portfolio to another if they're looking at retirement and they just, like we said, set and forget, and triple net lease is a great option. In residential, and I know in commercial too, but I always I'm fine. I'm happy with a 6% return, cash on cash return, very happy. But what I love is, to be in the path of progress, to make sure that that property is also appreciating, that there's something happening in the area where real estate's going to be of more value in the future. Because to me, it's the appreciation that's going to really create wealth, not that 6% return. So on a triple net lease, is that part of the equation? I mean, yeah,
It used to be.
it used to
It
be.
used to be. And that's a great question. And the reason why I say that it used to be is because, from a, again, macroeconomic standpoint, you would expect, between inflation and between just the regular motion of the economy, the value is going to go up at some point or another. In a triple net lease, they're typically longer term, 15, 20 years, and they have built-in escalations that go along with that. So that's part of what you would expect. So in the ideal world, an investor would expect to acquire a property at a certain cap rate and then sell it at a lower cap rate. Well, you touched on it. With interest rates where they are, that's not happening as much, and that's kind of why the volume is down along those lines. So in the ideal world, it makes sense, but it's just kind of in this market right now, it's just not as prevalent or possible, even because of some of the outside factors between the debt and the cost of debt.
Yeah, if you're making 6%, but you're paying 7 in debt, this
Yeah,
makes
you're
it
making 6, you're
challenging.
paying 7. Exactly. And the market's telling you that it's 7. What did we say? It was 6.5 on the cap rates
Yeah,
on that. So that's definitely the case.
that's a challenge. Okay, yeah, absolutely.
Mm-hmm.
A lot of people have been sitting on the sidelines, kind of waiting for this commercial real estate crash that, like you said, we're not really seeing because owners are holding and, buyers want a deal. And so there's a conflict, right, between buyers and sellers. When
Mm-hmm.
do you think that would shift such that it would really become a buyer's market?
I would put myself in the kick the can down the road camp, and I would say I don't see much changing in the next almost and I just went over this with someone the other day, almost through the next election cycle. Because if you say 6 months, then we're going to start getting into an election cycle. And what my experience has been is that when we're in that cycle, we're not sure who the next administration is going to be. You get by definition people sitting on the sideline waiting to see what's going to happen from a fiscal standpoint. So I'm thinking the next 12 to 18 months or so. But that's my camp. If you talk to some of the larger institutions, I think there's only maybe one or two of them that are a little more optimistic than that. But I would say even if we stabilize the increase in interest rates, we're still talking getting past the election, which is what the end of 2024.
Interesting. Well, I'm still seeing a lot of people syndicating, still acquiring. I had a deal come to me just recently that they're acquiring a 4.5% interest rate fixed with the deal, and I was just really
How much are
hesitant.
they putting down? How much are they putting down on that?
I'll
That
have
seems like
to I'll
a
have to
really good
look
interest
again.
rate. Yeah, because that's the other thing on. Was that for residential or is that
That's
for
for a
a
multifamily.
commercial? A multifamily.
Hmm.
Because the interesting part on that 4.5% is a great interest rate, and if you look at even the 6, 7, historically that's not extremely out of line. But what happens with the syndication part, and you're talking about loans coming due, is that the banks have a standard, what's called the debt coverage service ratio. And that debt coverage service ratio typically was in the 1.2, 1.25 range, meaning that your net operating income need to be at least 1.2 to 1.25, 1.3 greater than what your debt service is. And now we're starting to see that increase to 1.35 to 1.4. So if you have a loan, the way to manage that is you got to just put more money down. So I've seen as much as 60% down in order to just meet the debt coverage service ratio with the interest rates where they are right now. So
So,
that's the challenge.
so if you're assuming a low property and a low interest rate on that loan, you still need to be aware that the bank might want more money down at some point.
Right, but if you're assuming a loan, that's kind of like found money now with interest rates where they are. I have a couple guys on my teams that are working on a loan or working on an opportunity now where the loan can be assumed. That's found money.
Yeah. But so that would be the deal, is to find a fixed rate commercial property for a long period of time that meets the 1.4.
Buy you 3 to 5 years, exactly. Buy you 3 to 5 years at that same rate, and that way you might be able to make something work.
Yeah, good stuff. All right, Cedric, it's just a pleasure having you here. If people want to get in touch with you, they can go to realwealth.com, and just click on the Invest tab, and you're on there as the commercial broker.
Thank you. I saw that. And I do talk to quite a few folks that have an interest on the commercial front.
Absolutely.
Including loans, which is interesting.
Yeah. Great. All right. Well, you have a wonderful rest of your day. Thanks for joining me here on The Real Wealth Show.
Thanks for having me. It was a pleasure talking to you. Good seeing you
again. Good to see you. And thank you for joining me here on The Real Wealth Show. If you'd like to learn more about commercial real estate, we just recorded a longer webinar with Cedric, which you can find on our website at realwealthshow.com. Just click on the Learn tab. Once you're there, join. It's free. All you have to do is give your name and email address, and you'll have access to hundreds of educational webinars for free, from everything from taxes to asset protection to which markets are the best for cash flow and appreciation. You can get a free session with one of our investment counselors who all invest in these areas. They have been doing it a long time and are just awesome. So again, you can check it all out at realwealthshow.com.
The views and opinions expressed in this podcast are provided for informational purposes only and should not be construed as an offer to buy or sell any securities or to make or consider any investment or course of action. For more information, go to realwealthshow.com.